Hello friends, today we'll discuss about an interesting topic on accounting. That is nothing but accrual concept and matching principle. So why I find this as interesting? Because in my teaching life, I normally observe that there is a misconception among the students on this concept. So some of the students cannot understand the accrual basis properly, matching principle properly, and what is the difference between these two. They don't clear about it. So that's why I am making this video. So let's go to the main file. So what is the basic difference? Accrual basis tells about the timing of recording of a transaction. That means accrual basis tells when you will record your transaction. And matching principle tells about the performance measurement. That means how the performance of a business will be determined. So still not convinced? If not, please go through the full video carefully. I'll explain with examples and hope that you will understand properly. So at first, I will tell something about the accounting basis. There are mainly two popular bases of accounting in the world. One is cash basis and another accrual basis. There is another basis called hybrid system, which is a mixture of cash basis and accrual basis. Which is normally followed by some of the organization, not all, much. But accrual basis is the better option than other two options. So the definition of accrual basis, business transactions are recorded when they are occur and not when the related payments are received or made. That means when the transaction has been done, you have to record the transaction immediately. What do we mean by recording? I will give a link in the description box. You will get the understanding about the recording and transaction in that video. So when the transaction has been done, you have to record immediately. Whether cash has been received or not, whether partial cash has been received or not, that doesn't matter. You have to record. For example, this is the end of the May month. So throughout the month, you have to consume electricity, but you will get the electricity bill, for example, 10th day of June. But now you are preparing the financial statements for the month of May. So you have to record the electricity expense immediately because you have consumed the electricity and transaction has been done. As transaction has been done, you have to record the electricity expense as transaction has been done. So according to accrual concept. Some may argue that how we'll determine the amount of electricity bill as we have not received the bill. So you have to, that is a matter of provisioning. So we'll make another video on provision. So that will clearly identify how that will be made. But you have to record. That is the main issue. We'll see some other examples to understand the accrual basis properly. For example, a company sells TV both on cash and credit. For example, the company sells two television, one on cash and one on credit, and each television has sales value $1,000. So under the cash basis, as the one TV has been sold on cash and received $1,000, under the cash basis, that 1,000 will be recorded as revenue only. The TV sold on credit basis, that will not be recorded as revenue as cash has not been received. But that means this is the main problem of cash basis. You are not recording the full transaction, and that will lead you to the different results and wrong results and wrong decision making. But under the actual basis of accounting, you will record both the sales as revenue. That means $2,000 as revenue. Another example, for example, airlines sells their ticket normally before the flight has been made. So under the cash basis, when ticket has been sold, cash has been received, so that will be recognized as revenue, though the flight has not been made. But under the accrual basis, the sale of ticket and the cash received will not be recorded as revenue until the flight has been made. Initially, they will be recorded as unearned revenue. Then when the file will be made, that will be recorded as revenue. Another example like electricity bill, which has already been explained. So these are I think you have understand what is actual basis meaning. Now we'll come to matching principle. What matching principle actually tells about? Matching principle tells that when you prepare income statement for a particular period, you show revenue there for the period, and you have to show the related expense which has been incurred to earn the revenue in that income statement against the revenue to see the profit. That is the main concept of matching principle. For example, a company sells their product through their sales representative, and the sales representative is supposed to get 10% commission on sales. For example, and they will get the commission on the 15th day of the following month. So, for example, company has a sales in the month of December, dollar or taka 600,000. So the representative will get 60,000 commission, but they will get the commission in the following month, January 15. But if you prepare the financial statement for the month of December, you will record the revenue, for example, 600,000, and you have to charge the commission 60,000, which has been incurred to earn the revenue. So you will match the expense against the revenue to see the profit. Not only this expense, other expenses like cost of goods sold and other expenses, all expenses that has been incurred to earn the revenue, you have to charge against the revenue to see the profit. That means in a particular period, accounting period, how much revenue we have earned, you will show that revenue as a income or revenue. And to earn that revenue, you have to incur some expenses. So that expenses need to be matched with that revenue to see the actual profit or loss of that period. So if we go to the conclusions, then we can say that actual basis tells about the timing of the revenue as timing of the recorded transaction. That means when you will record your transaction, that means immediately. So it's a continuous process because you will have many transactions in a day and you have to record as much as possible immediately. One might argue that how the mobile operator will record their revenue immediately, because there is a call, there might be call in every seconds or every minute. So how is it possible to record the revenue in every minute? In that case, you can process batch-wise. For example, the whole day revenue data will be sorted out at the day end. Then at the day end, you will pass a entry to record the revenue. And it needs to be done every day on a continuous basis. But in case of matching principle, you will not do the you will not prepare the financial statements in every day. normally it might be monthly, maybe quarterly, or half yearly, or yearly, whatever it is. So for a particular period. So in that period, you will earn revenue that will show in the income statement, and against that revenue, you have to charge the all expenses that has been incurred to earn that revenue. That means you have to match the expenses with that revenue to find out the profit or loss. That means the performance of the organization. So now you have understand that actual basis tells about the timing of recording of a transaction, and matching principle guides how the performance of the business organization is determined. I hope I can explain the concept properly. If not, if you have any question, please drop your question in the comment box. I will come back to you as soon as possible. So thanks for today, and I will make more videos for you. Thank you very much for watching this video.